Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm interviewing Mark Yusko. How you doing today, Mark?
I'm doing great. Thanks for having me. And always excited to have a conversation about kind of what's going on in the markets in the world. And there's a lot going on.
Yeah. Well, before we dive right in, just want to give the listeners some background. I know a lot of listeners probably already know you, but I met Mark at a conference. Sat actually right next to him or across the table from him at a dinner, and we had a wonderful conversation. So I really wanted to bring him on the show. Just a wealth of knowledge. So Mark is the CEO and CIO of Morgan Creek Capital. Just really smart guy and just really insightful into a lot of the stuff that's going on. So Mark, tell us a little bit about your background and how you got to where you are today.
Yep. So short version, although Kirk, I don't do short well, so I'll try. I grew up on the left coast in Seattle, ended up at Notre Dame for undergrad, and then Chicago for business school. Kind of got into investing by accident. I worked in an insurance company and then an asset manager. And then I got the call to go back to the alma mater in the mid 90s or early 90s, and went back and worked in the endowment office. And what I learned working at Endowments, University of Notre Dame, and then came down here to run the endowment at University of North Carolina, was that investing was really about the big picture asset allocation. Picking securities was important, but it's less important than the big picture decisions. And so I started Morgan Creek 19 years ago to bring that endowment model of investing to other investors. And then 5-6 years ago, started something called Morgan Creek Digital to do investing in the digital asset ecosystem. So we focus on the ABCDs of the digital age: AI, blockchain, chips, and data. And so I'm affectionately what I refer to myself as is a late in life venture capitalist. I was an allocator for many years, so I allocated capital to other managers. Then I was an asset manager, built an asset management business, and now I'm playing venture capitalist for the next 15 odd years. And then I would say chapter 4, I'll teach and go back and do something at one of the schools I love. So excited to be here, and that's how I kind of found my way into the investing realm.
Nice. So let's start off about the endowment model, because I'm curious. I know a lot of listeners aren't familiar with this, and it's a really interesting perspective with how the universities have created their allocation. So tell us about the endowment model and why that's such a big deal.
It's interesting, and it's interesting that the endowments claimed it, because it's really more the sophisticated long-term investment model. It's not necessarily just endowments. I mean, there are foundations that use it. There are a few pension funds, some sovereign wealth, some large families. But it's basically a model that takes advantage of some natural benefits that an endowment or a foundation has over other investments. I mean, over other investors. All of us individuals, we have a finite life. We're all working on biotech to try to change that, but for now we got a finite life. Endowments, foundations live forever. Pension funds, kind of. Sovereign wealth, kind of. Multi-generational families, definitely. And so there's something called time arbitrage. So again, all of us, we're going to need our investments at some point. So we need some portion of them to be liquid, and we need to spend on things that we need to pay for. And so we have a time preference. Endowments, foundations, et cetera, can take that illiquidity because they have a longer time horizon. And so they pick up some extra return for taking those illiquid risks. So private equity, private real estate, private energy, private debt. And that's the primary difference. It's a focus on long investment horizons, taking advantage of illiquid assets in addition to liquid assets. There are a couple other things. I mean, one is an equity bias, but equity doesn't just mean stocks, right? There's public equity, private equity, real estate equity, commodity equity. And equity just means the opposite of debt or credit. Because in this world in investing, you're one of two things. You're an owner or a loaner. So you either own assets, you own equity, or you loan somebody money on credit. And so those two forms of investing, bonds and stocks, credit and equity, make up most people's portfolio. But then there's this next layer of equity, private equity type strategies. Then the other difference that the endowment model integrates is a value bias and a rebalancing discipline. So there's a strategic policy that an endowment will have, and it'll be an allocation to each asset class, like 30% to international stocks and 30% to US stocks and 20% to private equity and 10% to traditional fixed income, whatever that strategic allocation is. And on a periodic basis, quarterly or annually, you'll rebalance back to those targets a little more aggressively, maybe a little more disciplined than the average investor who kind of lets things run. And then a value bias just means, like to buy things when they're on sale. It's funny, Kirk, investing, only business I know, literally only business I know. When things go on sale, people run out of the store. Every other business in the world, you put something on sale, people will like run over each other to get inside and buy it. But when the price goes down of an asset in investment world, people run away. And the cheaper the price gets, the further they run. Like, wait, that doesn't make any sense. But it's an interesting dynamic.
Yeah, Black Friday, having mobs of people rioting to get the first TV. What so one thing that I always found interesting. So I love the endowment model idea, but I've noticed that in the college space, especially because you can see these, they're public, is that they become over the decades, they become increasingly in the private markets as opposed to public markets. In some cases, I think Yale is like less than 12% in the public markets. So why is that, and what does that do for the endowments versus just everyone else, me, everyone else is in the public markets. Why is that such an advantage?
Well, it's a huge advantage because it gives you extra return. So there's only 4 ways that you can make money as an investor, which is kind of crazy when you think about it. And all 4 of them require you to take risk. Now, if you take no risk at all, right, you put your money in cash, you get the risk-free rate, hence the name. The problem with that, it's actually the riskiest thing you could ever do, because all of the return that you make, so on average, the risk-free rate is around 4%. Sometimes it's lower, sometimes it's higher, but on average, it's about 4%. The problem is inflation is long-term average about 4%. So it chews up all the return that you're getting, and you lose purchasing power. So cash is actually a very, very risky strategy over the long term. Over the short term, it can be a good idea, particularly if assets are overvalued. But long term, it's a horrible strategy. So you have to choose one of 4 risks, or many of the 4 risks to take. One is credit risk. I can buy a bond, or I can, lend somebody money and charge interest. And the thing about that is there's default risk. But the nice thing about bonds, they're very secure because you have a contractual claim. If I lend you money, you have to pay me back or I can sue. And that means you have high security, but you don't make a lot of return. So the return above risk-free is about 2% on average. So on average, bonds make 6%. Sometimes they make less, sometimes they make more, but on average, about 6%. And that's not terrible, but 2% above risk-free doesn't really get the job done. So if you think about it, our goal in investing, and what an endowment goal is to make 5% in real terms, meaning 5% above inflation. Well, why do you need to make 5% above inflation? Well, if you're going to spend 5% every year, if you're a foundation, that's mandated by law. If it's an endowment, it's by practice. And if you think of a family, you might spend 5, 6, 7% of your money, of your nest egg. And so if you don't make 5% above inflation, then you're losing purchasing power, right? You're not making a real return. So if I only buy bonds, I'm 100% in bonds, I'm not going to make enough. So the second risk I can take is equity risk. Well, equities are a contingent claim. You only get paid if the bondholders get paid back. So you make a little more. You make 5% more than bonds, 7% above risk-free. Well, wait a minute. Then why wouldn't I put it all in equities? Well, you probably should put a lot in equities, and endowments do put a lot in equity, but we'll get to what types of equity here in a second. And so if I can make 7% real, 7% above inflation in equity, that's superior to bonds. Now, I'm going to own a little bit of bonds as a diversifier, maybe to cover my short-term capital needs. But an endowment, again, long time horizon, they know they're only going to spend 5% a year, or maybe even a little bit less. So they can be heavily equity oriented. But the third risk you can take is illiquidity risk. So I could buy a public stock, and the long-term return on public stocks, on equities, is about 10.5, 11%. Again, that's 7% above risk-free. Okay, but I can get another 400 to 500 basis points per year for buying private investments, venture capital, growth capital, buyouts, private equity, private real estate, all the illiquid. And the illiquidity premium is paid by individuals who need the money sooner to institutions primarily who can hold the money longer. And as a multi-generational families the same way. Then the last risk you can take, or last way you can make money, is leverage, right? You can lever up an asset and it adds value. Now, it can hurt you, right? Leverage, they say, can never make a bad investment good, but it can, unfortunately, and often does, make a good investment bad because you're forced to sell at the wrong time. So just simple analogy with your house. If you bought your house for 100% down, bought it for cash, and the price went up 10%, you make 10%. You have no leverage. Well, let's say you borrowed half the money from the bank and you put half down. If the price goes up 10%, you actually make 20%, 10 over 50. Well, what if you borrow 80%, like a normal mortgage, 20% down, price goes up 10%, you make 50%. So the leverage is amplifying your return. Now, the flip side, if the price goes down 10%, you could lose half your equity. Okay. So leverage is just a tool. It works really well in certain strategies, tougher in other strategies. And it depends on the volatility of the strategies. But those 4 ways of making money, that's it. Credit risk, equity risk, illiquidity risk, and leverage. And so you have to choose as an investor what you're going to do. And what the endowments do, Yale, Princeton, Stanford, Harvard, Notre Dame, UNC, Duke, all the places that I frequent or have friends that run those funds, what they figured out a long, long time ago, I know I only have to spend 5% every year. Now, if I'm an endowment and I'm out raising money, I have another advantage in that my nest egg, my corpus is growing. And so I don't even, I can actually use some of that inflow to fund my outflow. Not the purpose, because, endowments are specified. Like I could give a scholarship for left-handed tuba players and I can't give it to right-handed tuba players because it's specified. But dollars are fungible. Money that comes in, I can keep the things that are already invested, and I can use those monies that come in to pay the outflows. But because I know I'm only going to spend 5% a year and I might have some inflows, I can have less liquid assets, less stocks, less bonds, and more private assets, venture capital, buyouts, et cetera, because I'm going to get paid that illiquidity premium.
Okay. Yeah, that makes sense. So one thing I was always curious about is, you have these endowments, these colleges that basically built up this enormous amount of money, and it feels like, are they really spending it, or are they just building it up just for the heck of it because it's fun? Like I think Harvard is the largest, not.
No, it's a great question. It's really misunderstood. So let's say, you decide to give $1 million to your alma mater. Okay. So you give $1 million. By law, okay, the school can't spend the $1 million, right? They can't touch the corpus. All they can do is spend the earnings in perpetuity. Because remember, what you're giving an endowment for is to endow a program. So let's say you want to give a scholarship for asset management, people to learn financial literacy. Okay. So that $1 million will pay $50,000 every year to scholarships in financial literacy. And it has to do that forever. So you couldn't spend 50 of the million and then only have 950, and then spend another 50 of the million and have 900 every year, because then it would go away in 20 years. So you can only spend the earnings. So people get all focused on the corpus. You want the corpus to grow, because that means people are giving new programs. So every dollar that comes in is specified for some purpose. Like I said, I might have given a scholarship. I had actually, to my alma mater at Notre Dame, we gave a scholarship for merit. So we try to attract the greatest leaders to Notre Dame instead of going to Harvard, Yale, Princeton, Stanford. And we don't give it based on need. We give it based on merit and talent. And so we gave a certain amount of money, and then we give a certain amount of the return every year to fund that program. And so what people should really focus on is how much is the university spending on programs, not what is the size of the endowment, because the endowment should grow over time, because that means you're adding new programs. And the only way you can add a new program is to get a new endowment.
Okay. Yeah, that makes sense. I appreciate that. So let's dip into some interesting parts about this. So, getting a little bit away from the endowment model, let's look at kind of what's going on in the world. I mean, we've got a lot going on. Let's start with inflation. We talk about inflation a lot on this show.
Yep.
What are your thoughts on inflation? We had a big spike, and now it's lower, and the rates are high, and people think there's a recession. There's just a lot of confusion going on. So maybe you can kind of clear some of it up for us.
So the first thing is, I will argue that we don't have any inflation. What we have is currency devaluation. And you say, well, Mark, that's the same thing. Kinda, but not really. Inflation, right? In my mind, good inflation is where you have excess demand and limited supply of goods. So the price rises. And that's what you see in boom times, right? There's not enough supply of goods or service, and there's more demand, and the price has to rise. That's basic economics 101. So that would be the good kind of inflation. And that can be fixed by increasing the supply, right? Let's say gold prices are super high. You want prices to come down. You just got to go mine more gold. Or, service prices for, wait staff is really high. Well, then you got to, train more wait staff or produce more engineers if engineering salaries are really high. So supply and demand works really, really well. What the bad kind of inflation that I will argue isn't inflation, but they call it inflation, is currency devaluation, right? And what happened in 2020, this is crazy when you actually say it out loud. So we've been a republic for 247 years. In the first 244 years, we created about $10 trillion of money supply. And just because the T word is thrown around a lot, and nobody really, a trillion, okay, one single trillion, you and I, right, would have to sit here together for 31,710 years. And it would be tough to come up with stuff to talk about for that long. And we'd have to spend $1 every second for 31,710 years. That's a trillion. So we printed 10 trillion of these dollar bills. Now, they're not really paper anymore. They're ones and zeros in ledgers and bank accounts. But we had 244 years, 10 trillion. Then in the next 2 years, after the lockdowns, the powers that be, shall we say, I'll call them the idiots in charge, decided to print the same amount of money, another $10 trillion, all under the guise of, well, we need this to fight COVID. No, you don't. It has nothing to do with that. It was this woman, Stephanie Kelton, convinced a bunch of people in the administration that this was a good idea. It was never a good idea. It was a horrible idea. And it's been the downfall of every empire in the history of mankind, right? There have been 775 paper currencies in the history of the world. 3/4 of them no longer exist. Why? Because the governments printed too many of them and the value went to zero. It happened in Weimar Germany. It happened in Zimbabwe. It happened in most recently in Venezuela. And it's happening right before our eyes in the United States. So what happened is they printed all this money. So think about it. If you had 10 trillion over here on the left side and it print another 10 trillion on the right side, what just happened to the value of the money on the left? It just got cut in half. Think about that. It literally, the value of the currency got cut in half. So now I've been here in Chapel Hill, North Carolina, and according to Zillow, over the last 3 years, my house went up about 50%. No, it didn't. My house did not grow. My house did not get more efficient. It actually wore out a little bit. I had to replace some of the driveway and had to put money into it, but it didn't get better. My house did not get better. The money got worse. I use the example of gasoline all the time. Well, what's the lowest price you remember for a gallon of gas, right? I'm old, right? 60 years old. 33 cents. Totem Lake, Kirkland, Washington. 33 cents. I just paid $4.33 for a gallon of gas. Now, actually, I don't pay for gas anymore because now I have an electric car, but in my wife's car, she has gas. And so I don't have a Tesla, by the way. I have a Kia because I'm a value guy. But the key is that gallon of gas that I put in my wife's car does the same thing as the gallon of gas that I put in my car when I was a teenager in Totem Lake, but it costs, 13 times more. Why? 17 times more. Sorry. Why? Well, the money got worse. The money got way worse. And if you think about it, from 1776 to 1913, the value of a dollar was a dollar. And in fact, it's called the dollar because we stole it from the Rothschilds in the Netherlands. They had the first central bank. It's called the Rijksdollar. And we used the dollar to call it that. And then we copied the central bank model in 1913 and created the Fed. And since the creation of the central banks can print money literally out of thin air by fiat. The value of the dollar, Jay Leno made the joke, I heard they were going to issue a dollar coin. Why? They already have one. It's called a nickel. And that's what happened to the value of our currency, right? When I was growing up, you could buy a candy bar for a nickel. Now it costs you $1. So the crazy thing is we think that's normal because we've been propagandized to believe that inflation is good. On what planet is a system set up to take half of my wealth every 30 years a good idea? Just think about it, right? If you increase the money supply by 2% every year over 30 years, you will reduce the purchasing power of my wealth by half. That's not a good system. But what does that system do? Well, it channels money to the tippy top of the structure, and the people that own the assets make a lot of money. Here's a crazy stat that most people won't believe. You look at stocks. They look like they're at all-time highs. Well, not exactly all-time highs, but a couple weeks ago. Well, no, that's only because you price them in this depreciating asset called the dollar. If I price stocks in gold, which is the only money that exists in the world. What is money? Money is an asset that exists in the absence of a liability. Everything else we think of as money, like your background, that dollar bill, $100 bill, that's currency. It's backed by debt. It's actually not money. Money doesn't have a liability associated with it. So gold has been that for 5,000 years. If you price stocks in gold, they're dead flat since 1997. Because we've constantly printed too much capital. So the point is, we had the spike in inflation. Well, no, it wasn't inflation. It was currency devaluation that caused oil prices to spike. And then we had the lockdowns, which impacted used car prices. So used car prices spiked and you couldn't get a new car. And those two things caused this temporary blip. Now those things have reversed. Used car prices are coming down. Home prices are coming down because interest rates went up. Now the interest rates going up is interesting. So the normal short-term rate is 4%. That's been the normal rate forever. Now, why has that been the normal rate? Because the short-term interest rate has always approximated GDP growth, nominal GDP growth. Nominal GDP growth has been around 4%. So That makes sense. Well, but if inflation is 4% and my interest rate is 4%, then I'm not making any real return. Right. That's why you have to take risk. That's how capitalism works. You have to get paid for your use of your capital. And the problem is we cut interest rates to zero after the global financial crisis. The only other time we'd done that was in the 1930s, after the collapse and the Great Depression. And what we had was an irregular period that was referred to as the QE era, quantitative easing, where the Fed bought up all these assets, right? They were buying bonds because no one else would buy them because they were paying zero interest. Well, why does that matter? Well, what it meant was eventually we'd have to return to a normalized interest rate regime because, again, capitalism doesn't work if I don't get paid for my money, right? If I want to lend you money, you got to pay me interest. If I want to lend a company money, buy their bond, they need to pay me interest. If I'm going to deploy my capital in a business, I need to get paid return on that equity capital. So we raised interest rates back to normal, right? 5% interest rates. That's normal. Everyone says, oh, they're so high. It's actually very normal. And that's what it should be. But what it did is it caused that bubble that we had in prices caused by the devaluation of the currency to start to deflate. So now what we're in is this weird period where everyone was predicting a recession coming in this year, myself included. And why did I say that? Well, based on all the indicators, right? The yield curve was inverted. Everything was going down. Industrial production was falling. PMIs were falling. Productivity was falling. I mean, every indicator of recession, except for employment, was negative. But employment looked really strong. Well, why did employment look really strong? Well, it turns out they fudged the numbers in two ways. So one, every day in this country, 10,000 people turn 65. I have 5 more years, but every single day for the next 6 years, because my wife's the last year of the baby boom, 10,000 people will turn 65. Well, it turns out when you reach a certain age, you are taken out of the labor force, even if you're still working, right? When you reach retirement age, you're taken out of the labor force. Well, it doesn't make any sense, but they do it. The second thing they do that doesn't make any sense is we live in an age with computing and tracking that we know exactly how many people are working, exactly how much they're paying in payroll taxes, down to the very last person employed. We know that, but we don't use that data. We use something called the birth-death ratio to determine the non-farm payroll number. Well, what's the birth-death ratio? Well, the way they do that is they say, well, we're this many months into an economic expansion. Under normal circumstances, there'd be this many companies that are born and this many companies that die. And then we get a number of jobs created or lost. But here's the problem. If you assume we're still in an expansion rather than the recession that we were in 2022, which I'll come to in a second, then that birth-death ratio shouldn't apply. Because if we're in a recession, we're not any longer in an expansion. So you can't make up these jobs because you didn't count them. You didn't actually collect any taxes on them. You just said, well, there should be this many jobs. So about 3/4 of the million jobs that were quoted created weren't real. So those things kind of mess up. So if you go back to 2022, first quarter GDP was negative. Second quarter GDP was negative. Yield curve was inverted. We were in recession. Now, it wasn't a depression. It was just a shallow recession, kind of like 2001. No big deal. But nope. We're changing the definition. It's not 2 consecutive quarters. Well, no, it actually is. But okay, why are you changing this? Well, the NBER, the National Bureau of Economic Research, didn't say it's a recession because employment's still good. I'm like, well, right, but the employment numbers are cooked. So look at the real employment numbers and you would say we're in a recession, but they didn't want to call it a recession. The full year GDP growth last year was 0.9%, same as 2001, which was 1%. Anything sub 2% is a recession, but they didn't call it a recession. So we come into this year, things were looking dim, but what happened? China pumped $1 trillion into the economy in a reopening move. $1 trillion. Okay. Then when Silicon Valley Bank failed, the Fed pumped in 300 billion. Now they've since removed that. So the monetary policy is still actually quite restrictive. But here's what happened. I don't even know what to call them. The people in DC decided to go crazy on spending. So we went from a budgeted $500 billion deficit to a $1.7 trillion deficit. So we put $1 trillion into the economy through unemployment payments and disability payments and all these transfer payments to people, SNAP and things like that. Look, give me $1 trillion, I'll show you a good time too. So economic activity rebounded. We're back a little bit over 2%. Again, not roaring, but not recession. So I don't think we're in recession. I think we're in a, muddling along, and we're going to be that way for a long time because GDP growth equals working age population growth plus productivity. Working age population growth is going to be sub 1% for the next decade because there just aren't enough young people that are going to, age up because of the baby bust. And then you have this problem of productivity. Turns out 65 to 85-year-olds are not very productive. Perfectly nice people. I'll be one someday, but they're not productive. And so we know that both productivity and working age population growth are going to be, 1%. So GDP growth is going to be sub 2% for the next decade. That's not very good. And so we have this conundrum in that we're not in recession, we're not in dramatic expansion. So, how do we get the juices flowing economically? Innovation. You got to invest in innovation, and we're just not very good at that. And it's kind of sad, right? I mean, you think about our tax regime, like we tax capital gains. Should never tax capital gains. That's just silly. Should never tax income for that matter, right? Why would you tax innovation and wealth creation? Just makes no sense at all. You should tax consumption. Once people earn it, and they should be able to earn as much as they want, if they choose to spend it, tax the heck out of them. You want to buy a yacht, you pay a lot of tax. You want to buy a supercar, pay a lot of tax. People say, oh, it'd be regressive because you tax all, you can exempt all the low level stuff like food and necessities. But people want to spend a lot of money, they pay a lot of tax. So ultimately, we need to have a culture and a society that rewards innovation, right? This whole, let's tax the billionaires. Really? Why? Well, they don't deserve that. Like, why? Let's just take Amazon. I have nothing for or against Jeff Bezos, other than mad genius, built one of the great companies in the world. That company didn't exist 27 years ago. Okay. Today, in the last 12 months, it generated almost 100% of the net new jobs. That's pretty cool. Why would I want to discourage that by taking his wealth? It just doesn't make any sense.
Yeah, I mean, there's there's a lot there. One thing that that comes up is, it comes to mind is if I'm thinking about what's going on in the economy, right? It feels very confusing. And you talked about a lot of different areas. I mean, what is it? 40% of GDP is coming from the government right now, something like that.
Yeah,
some crazy number. So it sounds like
it's ridiculous. It's absolutely ridiculous. It's truly insane because they're literally printing money out of thin air and handing it to people directly and calling that GDP. That's not real. I mean, it's literally not real. And it has the impact of making life worse for the people at the bottom. Because you think about it, what that does is it increases, quote unquote, inflation because you're devaluing the currency by printing more of it. And therefore, the things that people need go up in price, like baby formula and gasoline. And the people at the tippy top get super, super rich because their real estate prices and their stock market prices go up. And the divide between the rich and the poor gets wider and wider. It's actually the widest today that it's ever been in history.
So let's talk about, I mean, we're down this negative reinforcement loop with where the direction of our country is going. How do you get out of it? Because I hear this a lot.
Leadership.
Well, but even with leadership, like, what can possibly happen to change the direction? Like, there is a point of no return. I'm not sure if we're there, but like, what happens to cause this to change?
Well, look, history is replete with examples of what happens. Empires fall and they disappear. Roman Empire, gone. Ottoman Empire, gone. British Empire, gone. Now, England still exists and London's still a cool place to visit, but it's not the center of the universe. Now, the Ottoman Empire, literally gone. Roman Empire, gone. And again, Italy still exists, but they have no power the way they did when they were an empire. And what will happen is the same thing that happened in Germany, in Weimar, and every other empire that thinks that you can create wealth by printing money. Because let's think about this. If creating wealth was as simple as printing money, wouldn't every country just do that? Right? I have on my desk over there a 100 trillion Zimbabwe dollar bill. Zimbabwe tried this, right? 100 trillion wouldn't buy you a loaf of bread. That's not wealth. And same thing with Venezuela, Venezuelan bolivars, right? Or Argentinian pesos. You got the same problem. So the problem is, this is a fundamental failure of leadership. It's when countries migrate towards dictatorship as opposed to democracy, and you concentrate the power in the very top with a very few people, and people make decisions that enrich themselves. I mean, I can't even believe, I think it was Mitch McConnell went on television and said, don't worry about that money we're sending to Ukraine. It's not going to Ukraine. It's going to U.S. military contractors. Now, if you mapped where those military contractors are relative to where the congressmen live, it's like a perfect correlation. Shocking. So there's crazy stuff, and it's on both sides. This is not a Democrat or Republican thing, because to me, there are no Democrats or Republicans. There's in and out. You're either in power or you're out of power. And when you're out of power, you do or say whatever it takes to get in. And when you're in power, you do or say whatever it takes to stay in. So for me, what solves it? Term limits. Throw them out, right? In the old days, right, you had a certain number of years. The framers, the founders of this country, had a couple years, and then you went back to your farm because you had to run your business. You didn't become a career politician. I mean, think about this. To become a senator in the United States cost $100 million. How many people have $100 million? Not very many. So how do you get $100 million? You got to raise it. Well, if you raise it, then those people give you the money. They probably expect something for that, right? I mean, if I gave you $100 million, I would expect you to do something for me. So this system is broken. And the one way to fix it would be term limits and get the career politicians out. Second would be reform campaign finance. Now, they tried that. Hasn't worked very well because they allowed the super PACs, which are probably worse than the original structure. The other way you could do it would be from the bottom up, right? If people focused again on this innovation and wealth creation, and they were incentivized to invest in new technology. I'll give you an example. If we passed a rule that allowed people in their 401k and 403b to invest in venture capital. Because think about this. If you're a 25-year-old kid, get your 401k, you literally can't touch the money for almost 50 years, right? Can't touch the money. Why would you be allowed to buy bonds? It should actually be against the law to own bonds in that portfolio. You should be mandated to invest in venture capital, in innovation, and give entrepreneurs capital to invent new businesses and create more Amazons and more Microsofts. But that's not what we do. What do? We force people to buy mutual funds and ETFs in traditional assets. Why? Because the people that wrote the laws are the people that run the businesses. This is crazy. The people at BlackRock and Vanguard wrote the law that guides how we invest our retirement. It's insane. How can they be on a committee that wrote the law? They're the beneficiary. That's a total conflict. That's how it works.
Yeah, no one seems to be watching the hen house anymore.
Well, it's populated by foxes, and they all like each other.
Yeah, I know. They're all buddy. What so let's also talk about because I know you've gotten deep into digital currencies and blockchain, and I'm very curious because there's a lot of obviously potential here with innovation technology, and most of it is in AI, blockchain. And there's a lot going on in that space, especially with some of the high profile failures in the blockchain space. So can you talk a little bit about that? Like where are the opportunities? What are you seeing in those spaces?
So blockchain technology, I will go out on a limb and say is one of the most foundational innovations of this century. I think it will create more wealth than the previous two tech booms combined. And what do I mean by that? So Web 1, which was pretty amazing. So from the early 90s to the middle to 2010s, we had this thing called Web 1, the internet. And the internet created about $2 trillion of wealth. Companies like Cisco and early days of Microsoft and Intel, really big business. But $2 trillion, and that was a lot of money. And that was all about read, meaning I could now get access to information ubiquitously, instantaneously. In the old days when I was growing up, you're a little bit younger than me, but you had this thing called the encyclopedia, like literally a bunch of books that you went and that's where you got your information. It was out of date. It was biased. I mean, it was crazy, but that was all we had. We couldn't type on a computer, and go to Wikipedia. So, and I'm not saying that's perfect, but all information in the world is at our fingertips every single day. That's better. So the web was good and it created a lot of wealth. Well, then Web 2 came along. Well, now it was about read and write. Now we could have things like social media and e-commerce and things like Amazon. Remember, Amazon's only existed for 27 years. In the first 10 years, it wasn't really much of a success. So in the last 15 years, it's created trillions and trillions of dollars of value. And Web 2 created about $5 trillion of incremental wealth. It's pretty cool. But that's read, write. Well, now we're going to have read, write, own. Well, what does that mean? Well, if you think about what the internet did, it made information available. Web 2 made information two-directional for the first time and exchangeable. Well, now value can be accounted for and exchanged, and you can own your identity, your data. Again, in the old days, you post content on Facebook and they monetize your content, or you send your DNA to 23andMe and you get your heritage and they sell your DNA to a drug company for $1,000. Why didn't you sell your DNA to a drug company for $1,000? They didn't know how. Well, in Web 3, all of these things will be ours, right? Our data, our health data, our intellectual capacity, everything will be owned by us using blockchains. Well, I'll give you a simple example. Money. In the old days, I lent you money and I wrote down in my ledger, papyrus or clay tablet or whatever it was, thousands of years. And you came back a year later to pay me the $110. And I'm an unscrupulous guy. I'm not trustworthy. You had to trust me, but I'm untrustworthy. So I wrote down 200. I changed the ledger. And you come back to pay me and the ledger says 200. And you're like, well, but I only borrowed 100. It's your word against mine. And I got the book. You were out of luck. So the Medicis 800 years ago borrowed this idea, stole from these monks. I used to never know who the monks were, but I went on vacation this year to Spain and Portugal, and I learned that the monks were actually the Templar Knights, the Order of Christ. They invented fractional reserve banking in Portugal. And the Medicis borrowed this idea and said, all right, Kirk, you keep a ledger, Mark, you keep a ledger, and we, the benevolent Medicis, for a small fee, will make sure that the numbers match. But here's the problem. They're corruptible. So I go to them and I say, you know, guys, I'm going to change my ledger to 200. Kirk says 100, and I'll give you half if you go along with it. So you come back to pay, you give me the 110, and I say, oh, no, it says right here, you owe me 220. And you're like, Medicis. And they're like, Kirk, you must have written it down wrong. I don't know what happened. And they're totally corruptible. So what do you need? You need someone looking over the Medici shoulder, an auditor or another trustworthy person. But then they're corruptible. So you need someone looking over their shoulder. So the beauty of blockchain, what blockchain is triple entry accounting. It solves this problem, right? It's a computer system where nodes all around the world, decentralized nodes, all say, Kirk wrote 100, Mark wrote 100. We are the permanent record that is 100. What that does is it gets us out of this game of the last 800 years where we need trust. Banks, brokerages, insurance companies, title companies, auditors, $7 trillion a year of friction to create trust. Think about it. I have a bank account. If I went to the ATM and I punched in my code and it said 0, how would I prove it's not 0, Kirk? I don't have a statement. I haven't had a statement in years. It's their word against mine. How would I prove it? It's really weird. It's total trust. I'm trusting that they take care of, now it's their money and I have an IOU. It's not even my money anymore. Remember, if you put your money in a bank, it's no longer yours, it's theirs, and you get an IOU. But I'm okay with that because I don't want to keep the money in my house. But it's all based on trust. Well, with blockchain, it can all be based on truth. I don't have to trust anybody. I know on the Bitcoin blockchain, if I have a Bitcoin, I have a Bitcoin. If you have Bitcoin, you have Bitcoin. If I transfer one to you, it's a permanent, immutable ledger. And that is an amazing innovation. So what blockchains do is they give us an ability to strip out, to liberate this $7 trillion in the trust industry, which is why the banks hate it so much, and use it for better purposes. And here's the cool thing. If you liberate $7 trillion a year, which is 68% of global GDP, and you put it back in the hands of the people, it turns out human creativity is the most powerful force in the universe. And with some additional capital, they'll create some amazing things. And so everyone says, oh, the AI is going to kill all the jobs. It'll kill a lot of jobs. The same way the steam engine killed a lot of jobs. The same way the internet killed a lot of jobs. But you realize we today have more jobs than any time in history. So we killed tons and tons of jobs. There are no more street sweepers in New York sweeping up the horse poop. They don't exist anymore. We don't have any red flag people anymore. People you had to pay to walk in front of your automobile with a red flag so people wouldn't run into you. We don't have any of those anymore. Lots of jobs got, we don't have textile workers in North Carolina because they'll move to China. Okay, that happened. But we have more jobs today than any time in history. And tomorrow we'll have more jobs. And the next day we'll have more jobs because innovation will create these jobs. And what blockchain does is by getting away from trust and moving to truth, we liberate this capital and allow us to build a better future. And so when I think about digital assets, I absolutely want to own Bitcoin. Bitcoin is the first use case of a blockchain, and it is digital gold. Well, what is gold? I said gold is money. It's the only money that's ever existed. A single ounce of gold for 5,000 years bought a fine person's suit. From Cleopatra's time to a suit of armor, to a zoot suit, to Savile Row today. Single ounce gets you a fine person's suit. Okay, perfect store value. But here's the thing. If I had a bar gold right now, and I wanted to break it in half and send you half, two problems. One, I'm not strong enough to break it in half. Okay, even if I could break it in half, I can't stuff it in my computer and send it to you. So it's not very portable and it's not very divisible. But if I want to send you Bitcoin, I can tap a couple buttons and bing, I can send you value. So Bitcoin is equally scarce. It's permanent, immutable truth, and it's portable and divisible. It's just better gold. Gold is the base layer of money in the world. All currency is built on top of it. Central banks own gold. They create currency using debt on top of it, dollars, yen, euros, bolivars, whatever. Same thing will happen here. Bitcoin will be digital gold, and then the digital age will be built on top of it, and every country will have their own digital currency. Now, some of that's a little dystopian. I don't want the government to be able to tell me how and when and if I can spend my money. Imagine this: central bank digital currency in the future. You get paid on Friday, go have a few cocktails, drunk text about the president, and you wake up next day, your money's only worth 70 cents. Mark, that could never happen. Yeah, it could. Or worse, they say, you know what, if you don't spend this money by Friday, it disappears to encourage consumption. Or worse, Walmart pays a little something, something to the government. Your money doesn't work at Target anymore. That could never happen. Yeah, it could. It could. So CBDCs, lots of problems and challenges. Governments are going to have them. They'll be digital fiat. China already has one. Ultimately, fiat currency is bad, evil, horrible, fine. Bitcoin's better. It's a store of value. Think about being in Venezuela. If you stayed in bolivars, all your wealth is gone. All your family's wealth is gone. All of it, gone, zero. Had you converted those bolivars to Bitcoin, you still have your Bitcoin, and it's worth a lot more. So same thing in Turkey, same thing in Argentina, same thing in the United States. 3 years ago, if you bought Bitcoin at $10,000, right, the money that you have is now worth half as much because they printed $10 trillion, right? The price of everything is up. So your value, your currency is down, but your Bitcoin is now worth 26,000. That's better. But the Bitcoin didn't change. One Bitcoin, still one Bitcoin. What happened is the money got worse because we price Bitcoin not in Bitcoin, we price it in dollars or yen or bolivars or Argentinian pesos. So it's that relative value that matters. Anyway, I digressed.
No, this is good. This is good. And it kind of brings up this one question of, there's obviously a trend. I mean, Bitcoin is kind of the the granddaddy of the cryptocurrencies. But when CBDCs come into form, which the U.S. has already talked about it, and I don't know how far away they are from actually implementing it. I know they started with FedNow and a few other things, but it's not immediate, but it's definitely imminent.
Not imminent for sure.
It's not imminent, but it's definitely going to happen. So I guess the question is what does that even look like? Because I mean, realistically, if you look at history, the bad money chases out the good, right? So if you've got a Bitcoin, you've got the CBDC, like yep. Who's going to use the CBDC if they start pulling the shenanigans, right?
Kirk, it's such a great point. Gresham's law says that bad money chases out good. And so people still use currency instead of gold. Gold is good money, but people still use dollars and yen and euros, even though the value of those keeps going down, right? I used to buy a Snickers bar for a nickel. Now it costs me $1. That's crazy. It's the same Snickers bar. And I probably shouldn't eat one anyway. But
invest in Snickers. That's the
invest in Snickers. Actually, look at Tootsie Roll. Tootsie Roll stock. It's amazing. So the key is that, to your point, Bitcoin and blockchain technology, I believe, switches this upside down. And you should actually have Murray Stahl come on the show and explain. He explains beautifully. He works at Horizon Kinetics. And Murray explains beautifully why reverse Gresham's law applies to blockchain technology and Bitcoin, and how good money eventually will push out all bad money. In my world, Bitcoin displaces gold as the base layer of money, and CBDCs exist on top. But he will argue, nope, they're so bad that eventually everyone will use Bitcoin and it will become the global money supply at $100 trillion. It's a very elegant argument, and he's very eloquent and very convincing. I would say he makes me seem bearish. And I'm like, I feel pretty bullish about this stuff, but he makes me seem bearish. But I like his argument, but history says that will take time. And so in the short run, everyone needs to have some of their capital in Bitcoin as a safe haven. Same way you would own gold or silver or platinum or anything else that would preserve your value as the dollar devalues. So you got to have some of that. Over time, you're probably going to want to increase that percentage and think about the next layer of use cases. So if you think about the world of digital assets, we're basically moving from analog to electronic to digital. So in the old days, we had analog things. I would take a stock certificate, you would take a physical piece of paper money, and we would meet under the buttonwood tree in New York and exchange. That was an exchange, an analog exchange. The problem was, if you've seen the movie Gangs in New York, on the way, the guys with the top hats would beat us up and take our stuff. So it wasn't really a very good system. So they moved it inside and eventually created an electronic system where we would take the paper and put it, the stock certificates go at DTCC and the paper money goes in the bank, and you and I exchange electronic numbers, QSIPs, and they move the paper around inside the different places. Okay, it's a better system. Well, but why are we using 400-year-old technology, paper, and electronic representations of paper rather than a digital representation in a permanent immutable ledger? We have the technology now with blockchain, and we have better chips and better systems. Let's do that. So ultimately, every asset in the world, every stock, every bond, every currency, every commodity, every piece of art, every collectible car, every case of fine wine, every piece of real estate, every private business will eventually be digital tokens. And a token is not a thing. It's a line item on a ledger in a permanent, immutable, secure, encrypted ledger. And all crypto means is cryptographically secure. And cryptographically secure is just a better way of holding data. Think about how many times you had to get a new Visa number because Visa still runs on a mainframe computer in COBOL, and eventually they get hacked and you lose your data and you have to get a new number. Not the end of the world, but it's inconvenient. In the new world, we have technology that can stop that. It's called cryptographic security, SHA-256. And people say, oh, but what about quantum? Well, if there's ever a quantum computer, which today there is one, but you got to cool it 479 degrees, negative 479 degrees. Seems expensive and inconvenient. But let's say someday there's a quantum computer, then they'll upgrade the cryptographic security the same way they, created it. So secure digital is the way the world is going. And I have a granddaughter who just turned, 10 months. And I always say, she will never have one of these. She will never have a leather wallet. She will never use paper money ever, right? She will only know digital world. She'll have a digital wallet, not a paper wallet. She'll use digital money, not paper money. And that's not good or bad. It just is the future. And technology evolves. And it's been evolving on this 14-year cycle for years. 1954, we had the mainframe, 68, the microchip, 82, the personal computer, 96, the internet, 2010, the mobile net, and 2024, next year, the truth net. And that is basically blockchains becoming the operating system, the same way that COBOL and Fortran ran mainframes, Spark ran microcomputers, Windows and DOS ran personal computers, TCP/IP runs the internet, iOS and Android run the mobile net, and blockchains will run the internet of everything. And so Web3 is a monster opportunity. Cryptographically secure assets are a monster opportunity. And the movement of technological innovation is as sure as the sun rising tomorrow, right? This is going to happen. And we're not going to put it back in a bottle. And look, technology can get delayed. I mean, people forget, right? Elon Musk did not invent the electric car. We had electric cars in this country in 1903. The biggest car company in America in 1903 was American Electric Vehicle Corp. And then Henry Ford basically shut them down so that people would buy his car. And he was originally going to run the Model T on grain alcohol. This is my favorite story. And John D. Rockefeller said, well, Hank, I got this stuff. When I'm making kerosene, I got this effluent, and I'm just putting it in the river. But the problem is the river catches on fire, so it must be flammable. So why don't you use that in your automobile? So that's why we use gasoline instead of grain alcohol. And the electric car was shelved for 100 years, and now it's back. And look, the idea of having a power plant on every vehicle is crazy. You should have a power plant that generates power and then distributed system, and you store the electricity on the car, and it's a better system. But it took a long time for people to figure that out. Now, if you produce the electricity with coal, that's not so good, because coal is really bad for the environment. But if you produce it with other forms like nat gas, it's fine. But ultimately, technology wins, and digital technology is superior. And this good money, this reverse Gresham's law that you identify, Kirk, is going to win out.
Well, I hope so. You know, I think it'll be really interesting to see, because you know, with all the power changing, I mean, this is, I look at, like, you know, the power centralization, right? Like, we think of, you know, whether it's political power or monetary power, and all of these innovations are changing the power structures significantly. Like the banks,
Yeah,
like you said, they're fearful of digital currencies and blockchain because of what it'll do to their business. And it's funny when you hear, like, the heads, Larry Fink and you know, a few of the others coming out and be like, well, blockchain's bad. No, blockchain's good, and blockchain's bad. And it's like, well, it's good because you're probably creating something that you can sell, but it's bad because it's going to destroy your business. And it kind of makes me wonder.
Every incumbent in history has fought innovation, right? The train companies didn't like the airplane business, and the horse and carriage people didn't like the automobile, and the phone companies didn't like the internet. Remember, the phone companies tried to pass a law to make the internet illegal. Al Gore actually stopped that bill. So he didn't invent the internet, but he was actually really important because he stopped that bill from ever getting the light of day. But they tried through lobbying, which is a fancy word for corruption, to make the internet illegal, doing what you and I are doing right now, talking voice over IP, where we're talking long distance for free. Verizon and AT&T liked charging us $2 a minute. They liked that. That was a good business. So they tried to block the innovation, but the innovation was better. And they have, you know, pivoted, and now they sell us internet services, which is hilarious. But the key is that ultimately the banks see the writing on the wall, and they were successful at shutting down a bunch of their competitors, Celsius, Voyager, BlockFi, right? Because what was happening is, I describe it in phases. There's the old Mandela quote, which Mandela didn't say, but somebody else said, but everyone thinks it was Mandela, so we'll go with Mandela, right? 2009 to 15, first they ignore you. Bunch of nerds and geeks playing with their magic internet money. Who cares? Whatever. Knock yourself out. 2016 to 21, then they laugh at you. Bunch of nerds and geeks playing with their magic internet money. Yeah, ha, 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 ha. You know, $1 billion goes into Celsius or BlockFi out of the banking system. Who cares? Ha ha, $1 billion. Chump change. 2022 to 27, then they fight you. 100 billion goes into Celsius and BlockFi. Now we got a problem. Now we got a freaking problem. So basically shut it down, choke point 2.0, the whole thing. And, you know, the whole SBF thing and FTX, it's all nonsense. But at the end of the day, 5 years ago, Larry Fink got on CNBC and said, Bitcoin is an index of money laundering. Why did he say that? Well, because that makes people afraid, money laundering. The largest money laundering organizations in the world are traditional banks. The banks globally have paid more fines, not done more bad stuff, paid more fines than the whole market cap of Bitcoin. Just let that sink in for a second. What they've been caught, admitted, although they never have to admit guilt. They just pay the fine and then they're not guilty. Whatever. If you pay, you're guilty. But if you're going to money launder, you're not going to use a ledger. You're going to use physical pieces of paper or bank accounts. That's how people launder money. But anyway, so 5 years ago, he said it. Then 3 weeks ago, he gets on TV and says, it's here to stay. Bitcoin's here to stay. And you need to get some to protect yourself against currency devaluation. My mind literally was blown. Now, why is he saying that? Because he's going to issue an ETF and charge you fees to buy Bitcoin. Now, you can go buy Bitcoin yourself, but the average person's afraid of the bare asset nature and custody and the technology. Remember the first time you had to put a video card in your computer? And you literally had to take the back off the computer and put the video card in there, and then you had to reboot it, and you had to format the hard drive. And oh my God, if you weren't a little bit techie, forget about it. Today, they come with multiple video cards and it's all done. And NVIDIA makes a ton of money. But in the early days of any new technology, it's only the early adopters and the geeks and the nerds who can do it. Over time, everyone will do it. And look, every single person uses this every single day. Well, except for the 40% of people in the world don't have electricity, but everyone else uses this every single day. Why? Do we understand how it works? Like, can you explain to me how you and I are talking into metal and glass boxes? And in real time, a signal goes into the air, into a cell tower, into the ground, across a fiber optic cable, into another tower, into another metal and glass box, and into your ear with no lag? Can you please explain to me how that works? Hell to the no. No one can explain that. But we use it every single day. But we don't care how it works. And so at some point, technology becomes invisible. It becomes ubiquitous, and we all use it. And that's what's going to happen with blockchain. That's what's going to happen with Bitcoin and digital assets. And we won't think, like I said, my granddaughter, she won't think it's weird at all to have a digital wallet. She won't think it's weird at all to transact in, the Lightning Network on top of Bitcoin. That will just be normal. She'll think it's weird, right? Just like, my kid looks at a rotary dial phone, like, what is that? I don't, you've seen the video of the two kids trying to figure out how to make a call. They're punching buttons and they don't know how it works, but that's okay. Or the old cash register where you punched buttons instead of scanning a barcode. I mean, technology suddenly becomes invisible and then everybody has it. So it's cool.
Nice. Well, Mark, I really appreciate you coming on the show. We got to wrap it up here in the interest of time, but maybe you can leave us with some final thoughts of where you think things are going. Final thoughts you think we didn't touch on that are really important to know.
Yep. So back to the beginning. So the endowment model is so great because it focuses on long time horizon investing, high equity weighting, broadly diversified, and take advantage of the illiquidity premium. If you can do that in your portfolio and life is better. You have better returns long term. In terms of economic activity and kind of return to normal, we're close, right? Interest rates are back to a normal level. We just got to get used to that again and recalibrate that zero was wrong. Having zero interest rates was wrong. Capitalism breaks down when that happens. It didn't work in the 30s and 40s. It was a bad idea this time. And we'll go back to normal. In terms of digital assets, everyone has to own some. And you don't have to put all your money there, but everyone has to get off zero. Zero is the wrong allocation. So, make an effort to get educated and spend some time. And here's the thing. In the 11 years I've been kind of following in this space, I started skeptical like everybody else. And I've never met anybody I respect who didn't start skeptical. But anyone who actually did the work became wildly bullish because it's amazing technological innovation. And when you combine the ABCDs together, AI, blockchain, chips, and data, man, the digital age is going to be amazing. And then lastly, if you care, I'm easy to find at Mark Yusko on Twitter, at Morgan Creek cap.com is Morgan Creek Capital here in Chapel Hill. And I appreciate being on the show and look forward to doing it again. I wish everybody happy end of summer and get back after it. And welcome to college football season and enjoy.
All right, Mark, thanks for coming on the show. Really appreciate your wisdom here. We'll definitely have you back on. I always love our conversations. So thanks again for joining us.
Yep. Thanks, Kirk. Talk to you soon.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Mark. Really appreciated him coming on the show and sharing his wisdom. It's funny. I had a great conversation with Mark at a conference. We were sitting at the table together. We had some fascinating conversations about the future direction of the U.S. and the world economically, politically. It was just really insightful guy. So I really appreciate him coming to the show and sharing his wisdom. Now we're into the panel portion of the show where we have our very own Barb Friedberg. Hey, Barb.
Good morning. How are you doing, Kirk?
Doing great. It's just you and me again. We've had a little vacation, back to school. It's all a mess for everybody. So it's just Barb and I for the interview. But so Barb, what were some of your takeaways for the interview?
The guy's really smart. I mean, I got to tell you, his memory alone is totally the envy of all, the grasp of his facts, history, and background. But beyond that, I thought his predictions are worth discussing. I was fascinated by how he approached bonds, venture, and private equity, as well as his thoughts on Bitcoin. So I'm thrilled, Kirk, to get in and delve into these issues with you.
All right. Well, let's start it off. So let's dive into, I guess let's start with the one everyone loves to talk about, loves to hate, Bitcoin. So what are your thoughts on his thoughts on Bitcoin?
Bitcoin, according to Mark Yusko, is the future. And his thesis is everyone needs to own it. And I'd like to say he may be right or he may be wrong. I'm going to take it a step back and say, I think blockchain is definitely here to stay. And what he said about blockchain, the ledger, the impenetrable nature of it, is nobody can dispute that. But how it's going to play out in our future, how digital coins are going to end up to be adopted, I think that's anyone's guess. And I'm not saying buy Bitcoin, don't buy Bitcoin. I really don't care. But what I am saying is we don't know what's going to happen in the future. Think about Netscape. Think about AOL. Think about all of these companies at the end of 1999. I remember when I bought my first computer in the late 80s. And so I asked my cousin, I said, what do you think I should buy? And I think he was like, well, you should buy a deck or something like that. I can't remember the exact name of it. I ended up buying a Mac, which, turned out to be great. One of the first editions open to the public, but we don't know what's going to happen. And I think the introduction is, let's just take a look. You can't really fail by sitting on the sidelines for a little while and seeing who's going to be the successful players going forward.
Yeah, it's interesting. I mean, the thing he said it rings true, because I've been thinking this as well, is, people who don't think Bitcoin is the future are typically people who haven't spent a lot of time. But if you talk to a lot of the smart people who've spent a lot of time thinking about the future, and of course, futurists is a thing, and of course, nobody can predict the future. So it's really kind of a guess, but you can make intelligent guesses, right? And so if you think about, Bitcoin or cryptocurrency or blockchain, like the technology itself, the smart people, when they get into the weeds, end up getting converted. And I find that interesting. I'm not saying that it is the future or not. I don't know. I don't know any more than anybody else. But what I find interesting is when smart people get in a room and they really dive into it and think about it, it's like, to me, it's just interesting. Now, do I think Bitcoin is going to be the future? I don't know. Do I think blockchain is going to be the future? 100%. But, blockchain is where things are going. Now, whether it comes in the form of CBDCs or Bitcoin or Ethereum or whatever, I'm not smart enough to know that. But the technology is not going away, because it solves a lot of problems, and it gives people a lot of what they want, which is freedom. And now CBDCs don't, but I think the people have seen the writing on the wall with the technology, and that's not going away. But I think it's always fascinating to talk to smart people when it comes to Bitcoin, Ethereum, blockchain, cryptocurrencies, just to get a sense of where their head's at. So we like to bring people on the show that have done that deep dive, right? It's like people talk about universal basic income. People have very strong opinions about it. And some tech people have sat down because they see the direction of tech and they say, oh, crap, what's going to happen? And they come up with these harebrained philosophies, in my opinion. But when you stop to think about it, it's like, I understand where they're coming from, right? I may not agree with the direction, but I understand where they're coming from. Like there's a real threat to that. So I think it's just all that we just need to kind of keep in mind, like, where our perspective's coming from. Are we zealots about our thinking, or are we more open-minded to, that's interesting. Like, I never thought of that, or I never thought of that. And I think we all, as investors, need to cultivate the mindset of being open-minded to anything, and to know that we don't know the future, so that we can take in more information and come up with better conclusions. So I just kind of talked about predictions, Barb, but obviously Mark made some on the show, and we talk a lot in the show about predictions. So what are some of your thoughts on that?
First, I need to ask you to explain something. What is CBDC?
Oh, Barb, you're old school. You don't know what a CBDC is? Okay, so I'm not the expert in this, but I can tell you what it is. So a CBDC is basically a central bank digital currency. And basically, if you think about what Bitcoin is a digital currency, or we treat it like a digital currency or cryptocurrency. A CBDC is a term coined, forgive the pun, coined by the community and the central banks. So the central banks are trying to come up with their own version of cryptocurrency. So if you think about like the dollar and the yen and the euro and the pound and all that, they are currencies. The central banks are trying to create a cryptocurrency, which is entirely digital. And people are worried about that because that gives them control or insight into the currency in a way that they never had before. In a way that, if you think about the direction of where that could go, it gives a government that has immense control over individual freedoms. Because if you have currency and they can just make it disappear overnight, I'm not saying they will, but they would have that power. That's a big power that people are going to be really, let's say if that happens, there could be some unfortunate events. The world is not going in a positive direction in that way. So people are really afraid of central bank digital currency, because at the stroke of a pen, they could say, your stuff's gone. You don't own it anymore. Or they could say, hey, we just printed 10 billion more CBDCs, and you get 10% more. Or they could say, we want to, we have to change the currency around, 10% of your currency is gone. Like, they could do anything they want. That power would be in their control, which is why people are so afraid of it. I'm not saying they will, just saying that is possible. Right now, if you have $1, you can squirrel it away, you can bury it in the yard, you can do anything. And unless they change over all the dollars, your dollar still has value. Dollars that were created 100 years ago still have value of $1. So we wouldn't have that anymore. So I think that's the fear around that. And I think a lot of people are concerned about that trend. And the trend is inevitably going to happen. So anyway, Barb, back to you.
Yes. Predictions. So I pretty much agree with you, Kirk, which is, rare, I'd say, but I think it's a good idea for people to be open-minded, to listen to the conversation. But just because you're listening doesn't mean you have to do something now or today. There's a marketing term that describes trendsetters, trend followers. It's called early adopters. And those are the people that they hear about something new and they're on it. Those are the men and women who are first in line for the new update for the iPhone. Those are the people that want to be the first. And then there are the people that are like, well, I'm going to sit around and see how things play out. And then there are the late adopters who say, not only am I going to sit around and see how things play out, but I don't care if everyone on the block has a cell phone. I'm not getting a cell phone. So no matter where you are on the spectrum, we all know, if you've been alive for more than a minute, that technology is advancing our society. It is changing it in ways that were unimaginable 10 years ago. Whether you want to drop on a new trend today because someone predicted this is the new thing of tomorrow, that's fine. Just understand that there's a risk. There's a greater risk of being an early adopter. You have a greater chance of hitting it out of the park. If you bought Microsoft at the IPO or Apple at the IPO, you'd be a gazillionaire. Awesome. But if you waited a few years and bought in, you're still doing okay.
Well, that brings us as a good segue into the next question, Barb, which is Mark talked a lot about private investments, private equity, venture capital, things like that, and how, especially in the endowment model, a lot of money is put into those sectors. Of course, the endowment model is a perpetuity time frame. So whereas most of us, maybe everyone else, not me, mine's perpetuity. I'm living forever, Barb. But for most people, they have a lifespan that has an endpoint to it. So, what are your thoughts on private equity, venture capital, or just private investments in general?
Before I get to that, I want to talk about a TV show I saw recently where people embedded tech into their bodies. Have you seen that, Kirk?
Which show? There's a few of those
out there.
It
was like a documentary or something where people embed tech in order to become like more efficient in different realms. And, they have these little chips stuck in that could do all sorts of different things. And I'm thinking, that may be a thing of the future, but that is not something that I want to do. Leave the $1 Million Man to television in my book. So in terms of private equity, yes, no, maybe. We've talked a lot about this. And with the Jobs Act, many companies opened up private equity, venture capital investing to the average person, or sometimes the accredited investor, which is a wealthier person, or someone who works in the financial industry to invest in these types of private companies that are not regulated by the Securities and Exchange Commission, that are riskier, that require your money to be tied up for longer periods of time, that promise much higher returns. And there's a flip side to that, which is, of course, you have to tie up your money. That goes to the idea of longevity. Maybe I'm going to need my money in 5 years. I don't want to tie it up for that long. If that's the case, you don't want to investigate private equity. You like liquidity. Or maybe I'm not willing to take the risk. Those wealthy individuals who are going and investing in private equity, venture capital, which are new companies that are coming along that promise to change the future. There's a risk. Most of those companies go to bust. So how can you invest in these deals? If you're really rich, people come to you with them, and you have to have your due diligence or your due diligence team check them out. If you're of a normal wealth level or just a little bit rich, then you can get these type of investments on different crowdfunding platforms. Personally, am I a fan? Yeah, I've invested in one or two, not a lot, but I am old school, Kirk, and I'm not ashamed to say I'm okay with just going with cash, stocks, and bonds. Average returns of bonds is 5%. Average returns of stocks is 9 to 10% over about the past 100 years. If that plays out going forward, I can deal with that.
Yeah, it's interesting. You talk about the you mentioned before the early adopters and late adopters. It's funny, when I was a kid, I was an early adopter. I needed the new game system, I needed the new technology, I needed the Apple II GS when that was like cool. Before there was GS was graphics and sound, and I always had like the early tech as a kid, and as I've grown up, I've kind of aged through that spectrum, and now I'm more of a late adopter in some cases. Not because I'm not aware of or against the technology, but more like if you think about it, like for instance, like when I was young, you had technology and it was isolated to you. It was just you, right? You had a game system, you played it. There was no one else in the room. There was no one else you could play with. If you wanted to play with someone else, you invited them over to your house and you had another game controller and you sat there next to each other and you played each other. It was awesome. Now, no one comes over anymore. Everybody just has their own house and they just kind of, they all go through the internet. And what I find fascinating is back then, there was no risk of adoption. Now there is risk of adoption. So, the kids are typically early adopters. So, hey, they're in Facebook, they're in Snapchat, they're in TikTok or whatever they're in now. And they don't understand the implications of what they're doing because they're kids, and they shouldn't have to know the implications at a young age because they're kids. They should be kids. But the other hand, as parents, we do know the implications. The second you put a picture of you doing a keg stand or a bong hit on Facebook, it's permanently on the internet, and your employer, you're not going to get a job again because the employer is going to be like, oh, I'm not going to hire that guy or gal. Or maybe you find employers like, I definitely want that guy or gal. Maybe that's the one you don't want. But anyway, the point being is the internet has so many broad implications that if you're an early adopter, it's really hard to think through these implications. So in social media, there are very broad implications. But, if you look at cryptocurrency, there are also broad implications, right? And that's the whole point. And that's why I find it interesting that after smart people have thought about it a long time, they come to the conclusion that this is the direction. It may not be Bitcoin. I mean, by the way, Mark is a phenomenal teacher. If you guys didn't get this from the internet, from the interview, phenomenal. Some of the explanations he gave were awesome. Some of the best I've heard. So kudos to Mark. His next iteration, he said he's going to be a teacher, a professor. He should. He's really good at it. So as he explained Web 1, Web 2, and Web 3, like those are iterations that have changed. And so as technology progresses and advances, sometimes it takes a while to think through the implications. And I'm not saying that if you have the Apple, 12 Pro and you go to the 14 Pro, it's going to be life-changing. But if you're talking about, a new technology like AI, what are the implications? Well, it came out in November of last year, and by December, some college kid had already set up a program to determine whether it's AI or human created. I mean, the implications are enormous for where technology is going. And AI is scaring the pants off people because, and I think, you could argue whether the big tech titans, where their bias is. But I think that if you remove the bias from the room, they said, all right, let's all slow down here for a minute. I think there's an implication that if they were responsible tech titans, they would be sitting there and saying, we should maybe think about not putting this out there yet until we fully understand where this could go. Because I've read some articles that are scary in the implications for where it could go. And it may be where we end up going. It's like when you create the nuclear bomb. Like, you let the cat out of the bag. You can't put that back in. You can't uncreate something. So once it's created, it's done. AI is out there. It's not going back in the bottle. But the responsible dissemination, I think, is a question that people need to understand. And so, with age comes wisdom. And I'm not that old, but I'm old enough to have some wisdom about me to know that there are things you just don't do. As a kid, I did some things that today I probably wouldn't have gotten away. Well, I definitely wouldn't have gotten away with. I wouldn't have then, except we didn't get caught. Back then you did all sorts of shenanigans. But now, like, everything's on camera, everything's in film, everything's recorded. Like, you just can't. There's no shenanigans. So, as kids, I know kids get into trouble. It's just normal. And they don't have the wherewithal to understand. And so I think as I've grown, I've become more of a late adopter just because of the implications, not because I'm against it, just thinking through, like, all right, is there any risk to doing this? Is there any risk to doing that? And maybe that's just how I'm wired. I'm a risk manager. That's what we do professionally. That's what we do with portfolios, is managing risk. So maybe that's just my wiring. But as I think through things, it requires a lot of thoughtful engagement of new concepts to make sure that, if there's a CBDC, what are the implications? Well, it could be significant. It could be wonderful and significant at the same time, right? And dangerous at the same time. Could be all those things. So anyway, going down that rabbit trail, I want to talk about one more concept here, and we can wrap it up, Barb. We talked a lot about the endowment model, and we don't talk about that a lot in the show, but it's really interesting. So I don't know if you have thoughts on that, or if that's something that because you hear a lot of individuals talking about doing that. Is that something individuals should pursue?
Only if you never plan on dying. So, Kirk, maybe you can.
Yeah, I'm raising the roof over here. That's me.
But the problem for us individuals are, not only are we finite, we all have an expiration date, but we don't know what it is. As I get up there, I'm like, Bill Richardson died, Jimmy Buffett died. It's like all these people that I think
Come on, Jimmy Buffett was going to live forever, Barb. Don't let anybody fool you on that one.
They're like, they're older than me, but not by a huge margin. They're in my generation. And it's like the task that we have at hand is making sure financially, obviously there are other jobs we have as human beings, but financially we have the task at hand to make sure that we do not have more life than money. And that is our goal. Nobody wants to plan on living to 85 and then live to 102 and have 85 to 102 with no money, or a Social Security check of $1,500 a month. So do I believe in the endowment model? Not for individuals. I think really I had a fascinating meeting with a financial advisor friend of mine a couple weeks ago. He's a well-known guy, and he got a nice payout for selling his business. And so we're talking about investing. And I said, so, what are you doing? He must be in his late 40s, I guess. He said, I put 100% of my money in one fund, which is a diversified stock fund that covers international and US and a variety of different investment styles within that fund. No bonds. He says, yeah, I have a little cash, but that's it. And his thesis is, look, I don't need the money now. I'm still working, and stocks have had the best long-term return over time of, the majority of asset classes. And so I'm just going with that. I said, well, the stock market has had many 40% drops, 30% drops, 25% drops within a short period of time. Aren't you worried about that? He said, no, it always comes back. My response was, well, you've got a stronger stomach than I do, because I'm the worry ward of every group, believing, yeah, the stock market will probably come back because it always has. But I think it's not a bad idea to remain diversified in your investment portfolio, even if you're young. There's nothing wrong with having a little bit of a bond allocation, a little bit of a cash allocation, a stock allocation. If you want to throw in a venture or a private equity allocation, make it a smaller percentage of your portfolio, simply because you're not going to live forever. They're riskier, and they require a longer lockup period for your cash.
Barb, where can people find more about you?
You can Google me, Barbara Friedberg. You can find me on my website at Barbara Friedberg Personal Finance.
All right. Well, Barb, thanks for coming on the show. And it's funny, I just read an article yesterday. There's a guy, I think his name's Brian Johnson, on Twitter, who talks about living forever, and he's got like a thing on. It's funny. I mentioned it because we've been joking about this in the show, but it's funny because he has a thing. There's like people have written articles about the vampiric tech titans in Hollywood, in Silicon Valley. And this is one of those guys where he's basically taking blood plasma from his 18-year-old kid, and it's causing him to have much better health. And it's interesting. I'm not saying I'm not saying you should do it. I'm just saying it's interesting that there are people out there doing that. So I'm excited for the next 50, 100 years, because by then hopefully we'll have some solutions. Maybe we'll find out if the guy grows fangs and starts drinking people's blood. But either way, it's interesting to see people are out there actually pushing the boundaries. So kudos to him and others that are doing that. Hopefully it's ethical, but I haven't looked into it that much. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.